Hi, it's John Shaw with the second quarter update for the CI Global Investment Grade Private Pool class. We saw four broad economic themes that drove fixed income markets in the second quarter. Vaccinations are allowing economies to reopen, however, new variants pose a problem globally. Vaccination rates are stalling in the US while continuing to climb in Canada. Coming off low GDP figures a year ago, we've probably already reached peak quarterly US GDP growth. As the North American economy continues to grow on the back of increase in consumer spending, corporate profits are rising. From a monetary perspective, central banks remain very accommodative, however, are becoming less so, with the Bank of Canada being the first to trim its quantitative easing program. In June, the U.S. Federal Reserve indicated that inflation may not be as transitory as first thought and have begun discussions to taper its QE program. These macroeconomic themes drove capital markets in a couple of ways. The first being a modest decline in U.S. government bond yields due to A, investors pricing in sooner than expected rate hikes, which would limit inflation, and B, slower global growth as COVID still poses a real problem. The second being continued tightening of credit spreads due to ongoing investor demand, low net bond supply, and a positive economic backdrop. U.S. IG spreads broke through pre-global financial crisis levels, while U.S. high-yield spreads continued their trend downward as investors search for yield. As a result, we saw positive performance across all fixed income sectors. In the second quarter, the Series F version returned 2.25%, outperforming the category by 99 basis points. While this was due to our credit selection in IG corporate bonds and asset mix that included satellite positions in high-yield credit and Canadian preferred shares, we maintain a neutral to positive outlook for credit. IG corporate bonds continue to offer greater total return potential versus government bonds given improving corporate earnings and balance sheets, plus our expectation that government yields will rise in the second half of the year. High-yield corporate bonds offer improved carry, while Canadian preferred shares provide an attractive dividend and enjoy a strong technical backdrop due to the introduction of LRCNs last summer. Based on our outlook, the pool is overweight credit, given the greater potential in the asset class and shorter duration given our negative rates view. The reopening trades that we engaged in last year continue to play out and are the pool's top performers. Asset mix and security selection will drive outperformance moving forward.